Welcome to Tony Byrne's View with news you can use. Tony has over 32 years of experience as a chartered financial planner and wealth manager. Tony's passion is to help you retire early and live the life of your dreams with no financial worries. Now to today's episode.
Today's subject is cash. I've entitled it Cash is King Sometimes. That's a bit of a tongue-in-cheek title because back in January, before this coronavirus outbreak, I wrote a blog called Cash is Not King, thinking I was being quite clever, but with hindsight, I wasn't. I realised I made an error there because I didn't anticipate one of these so-called black swan events. So what is a black swan event? Well, for those of you who are not aware, how many black swans have you ever seen in your life? Not many. That's why the coronavirus pandemic is what's known as a black swan event. Very unexpected. And even myself, I was a bit complacent about it at the outset, thinking it wouldn't spread as wildly as it has done. But of course, it's a shock to us all. And the stock market, as a result, crashed between February and March. It fell a huge amount, in the region of 40%. And of course, if you'd been in cash at the time, you'd be laughing, thinking an article entitled Cash is King, or Cash is Not King rather, is not appropriate. But of course, nobody can predict the future with 100% accuracy. The reason I wrote Cash is Not King, it was based on long-term investment. All the research into long-term investments in the main four asset classes of cash, property, shares and bonds show that cash produces a very, very poor return long-term, even before taking into account inflation historically, and that shares outperform everything long-term. But of course, shares are more volatile, so prices will rise and fall. I did wonder if I missed a trick a bit, because there is this well-known fella out there, most of you will have heard of by now, called Warren Buffett. He's the world's most successful investor, and he runs a fund called Berkshire Hathaway, which is a mixture of lots of different companies now. It was originally a textiles company when he took it over, but he completely transformed it into effectively a fund, but it's really just a company that invests in other companies. It's now become the largest company in the world outside of tech companies, which are the largest companies in the world. So it's quite extraordinary growth he's managed there. One thing that's interesting about Berkshire Hathaway is that they have a huge amount of cash, $137 billion at the last count. That does seem disproportionately high, but back in 2008 when we had the financial crisis, of course, Warren Buffett had a lot of money in cash then. It appears that he seems to stockpile cash when markets get too high, and he anticipates a big fall. So what happened in 2008? Companies were queuing up to lend money to him to get him to invest in their companies by buying what are called preference shares, which means you've got convertible preference shares, which means you've got the ability to invest in a bond that pays you a fixed interest, and he negotiated rates of 10%, and it gives you the right to convert into so many shares at a later date. And in his case, it was on very favourable terms. So whilst markets were crashing, he was making 10% a year and then converted into shares at a very favourable rate and made a huge sum of money as a result, several $billion, probably the tens of billions of dollars as a result. Is he going to do the same thing this time? I don't think that's likely, because there's so much money being offered by governments and banks very cheaply, if not for free at the moment, that really even Warren Buffett can't compete with such great credit terms. Nonetheless, you do wonder why his companies have so much money in cash. Warren Buffett is quite modest, doesn't give much away. He argues that because they own insurance companies in his group, that they have to have a lot of cash reserves to meet claims. I'm not sure that's the only reason he's doing it. I don't think he can find value, because in the stock market at the moment, especially in the United States, represented by the S&P 500 or the NASDAQ, the technology index, share prices, but on any measure, are at historical highs. I think Warren Buffett has realised there isn't much value out there, and he's waiting for a big fall. Will this happen? Only time will tell. Unfortunately, I can't predict the future. If I did, I probably wouldn't be carrying out this podcast. I'll be on some sunny beach in the Bahamas enjoying my time. But I'm afraid I'm not that good at predicting the future. Nonetheless, I do think it's likely there could be another fall. It's more than likely there's going to be another fall, and it will probably be worse than the previous fall in February, March this year. So what you might like to consider, if you have a financial advisor, hopefully that advisor is me, you may like to consider reducing your attitude to investment risk from your current level to a low level. And the reason for that is because it will mean you will invest less money in shares and more money in the other asset classes I mentioned earlier, cash, bonds and property, which on balance is probably the most cautious and safest option at the moment, because it looks like markets will fall again. But don't take my word for it, it's not guaranteed. Remember, markets can remain irrational longer than you can remain solvent.
Thank you for listening to today's episode. If you enjoyed it, don't forget to share it with your friends and family. For more information, head to www.wealthandtax.co.uk.